Hey, Eduardo, nice to see you. Neelan, hello. Welcome, everybody. I'll be starting this in about a minute. Antonio, how are you? Edward, welcome. Nice to meet you too. Hi, Neelish, Jason, Marlene, Brian. So we've got some veteran members and some new people on this. So welcome, everybody. I'll be starting in just a moment. ATL, nice to see you. So we're right on the dot. Brian says, nice bounce today. Yeah, I projected that or predicted it from the get-go in my early morning session. I think, Brian, you're part of that. So welcome to this live 3-day event. This is a live trade execution webinar series, kind of subtitled How to Capitalize on Monster Moves in the Markets and Also Avoid the Market Traps. My name is Mark Shaws, I'm the Pattern Trader. So we have some established Pattern Trader members and some new people here. So for those of you who don't know me, I'll just give you a brief background. I've been trading the markets for decades now. I got my start many decades ago, where I was studying fundamental analysis at one of the best universities in the country. And then I met a commodities trader by the name of Graham Loving. And Graham was actively trading the commodity futures markets at a time not too different than what we have today. This was in the late 1970s, where we had oil embargoes and interest rates going to 20% and inflation and markets much like we see today. And Graham was actively trading 25 exotic markets all at one time: live hogs and orange juice and cocoa and soybean meal and T-bond futures and live hogs and gold and platinum. And I just couldn't understand how he was, understanding all of those markets. But what I came to find out, that Graham was just focusing on the price. And again, this was many decades ago, but before fancy chart services and whatnot. He just took out a simple piece of graph paper, plotted an X and Y axis for time and price. And then every day he would plot the closing price of live hogs or soybeans. And he said to me, Mark, I simply want to buy a market that's going up or sell a market that's going down. And to my simple way of thinking, my simple brain, that had a great deal of appeal to me. And so that was my introduction to what we call technical analysis, the study of making investment decisions exclusively based only on price. Now, I always get the question, do I trade the news? And the short answer is no. To me, the markets are a discounting mechanism, means that the markets are ahead of the news. Whatever we're reading about in today's Wall Street Journal, the markets were already foreseeing days or weeks or months ago. And so what I look for is the tea leaves, the price patterns, the price action that gives me an insight where the markets are likely to go. You're not going to learn that by listening to some commentator or being on some forum. And so this is what we do at the Pattern Trader. I started this business 7 years ago, really to give back all the things that I've learned along the way, making all of the mistakes that you're likely to make, and hopefully I can help you avoid that. So what I'm going to do over the next 3 days is actually just go into the markets in real time and show you how I analyze a trade, how I apply a 4-step trading methodology to basically look for and find high value trades, high value setups, where the risk is far greater than the outcome. And that's really what trading is all about. We can, kind of be armchair economists here and try and figure out what the Fed's going to do. And is inflation going to stay the same, or is it going to go down? What are interest rates going to do? Those are really just not even relevant discussions for trading, because trading is all about risk and reward. Where can you identify the smallest level of risk for the biggest outcome? And this is what I try and do on an ongoing basis. So what I'll do is I'll show you first off what I do in the markets. This is my real account. This is not a demo account. And unfortunately, it's at a broker that really doesn't show kind of the P&L. So I came in short today, 3,500 shares of Tesla at 207. Right now, Tesla is trading at 197. It's trading $10 lower. So when you're short, you're actually betting on a decline. So when the market goes down, you're actually making money when the market goes down. I know that might not be a familiar concept to a lot of people, but the markets have been collapsing. And so what most people do are buy and hold. They kind of sit through the storm, hope that it stops, and one day it goes up. What I do is I take advantage of those market declines. If something's going to go down, I want to ride down with it. And actually, as we found out, that gravity actually works. Gravity pulls things down much faster than things go up. And so I am very bearish on the price patterns in Tesla. I've been talking about an implosion in the price of Tesla for a long time. And I think we're just starting to see it. This is the first time that we're hovering below 200 in a while. And I'll go to the charts in a minute. Now, we do have, for those of you outside the United States may not know, tomorrow, November 8th, there will be a midterm election, an off-year election in the United States, where we elect new senators, new congressmen, etc. And it's kind of generally widely anticipated that the Congress is going to flip from the Democrats to the Republicans. And it's also likely that the Senate will follow suit. And, as do I, the markets like when there is less government interference in the markets. And so with the prospect of the Republicans gaining control of the House, as opposed to, the president who's dead, you have what's called a gridlock situation where government can't do any more harm. And so the market generally likes that. And so I've taken some very extensive bets on, a rally in the stock market, despite the fact that things have been very bearish. We still have a chairman that is very intent on raising interest rates, stamping out inflation. That's really bad for stocks. But I do think that there are certain what I call technical levels, as well as I'm just playing a gut instinct. This is somewhat of a gamble that we're going to get somewhat of a rally in the next couple of days and maybe even the next couple of weeks. And it could be a rip your face off kind of rally where the market has just been so punished that, if we get some kind of outcome tomorrow, the market could really just go ballistic. And so I made bets early this morning. I started buying call options in the IGV. The IGV is an ETF made up exclusive of technology and software stocks, like Apple and Microsoft and Intuit. And this has been a very, very beaten up sector. I don't think the carnage is over, but I do think we could get a relief rally, and it could be quite substantial. So I made a real bet, a leverage bet, where I bought the call options. A call option is basically a leverage bet that whatever instrument you're buying a call on is going to go higher. And these expire in 2 weeks, so I still have some time. And I bought the 255 call options when the IGV was trading at about 242 this morning. So that's what we call out of the money, where it's 13 points out of the money. It still has to go above 255 So even though it's showing that I'm making 43,000, actually these are worthless if they close under 255 by November 18th. So these are very leveraged gambles that, we're going to get a big move, but I might not even have to wait till the 18th. I'm just, betting on that we're just going to get a charge over the next 2-3 days, and that I could double my money, triple my money, quadruple my money, and, be out of there. Similarly, I bought calls in the QQQs. These are an ETF that is basically the NASDAQ. We have Microsoft and Apple and, all the stocks in the QQQs that make up this ETF. And so I bet a call on that. This has also been very beaten up. I'll show you a relative chart in just a moment. And I invested quite a bit of money in that. I started buying the call options today at about $1.40. You can see here, then I bought some more at $1.60. I bought them all over the place, and they closed at about $1.85. The market settled higher, but they're still out of the money. The Qs are trading at about 267.5, and this is 275. So this needs to go up 800 points by the end of the week. This expires on Friday. So it's really a race. And if I don't make it, I'm going to lose a lot of money. So, I put a bet, that we're going to get a liftoff in the next couple of days. These are some FX positions, some currency positions. I'm long the euro. I'm short some Canadian dollars. I bought the NASDAQ in the spot market. I bought some Australian versus US, and I also bought some gold. So those are the positions right now. So these are basically the format of what I do. I send out emails every night to those on a particular list, a particular funnel that we have. And, a couple of weeks ago, I said you should short the New Zealand dollar Canadian. I always show what I'm looking at on the chart. I said you should add to your shorts. And then, I made quite a bit of money in those short positions over that period of time. So this was a point where I said you should short gold at 1801, short silver at $21. And I ended up making several $100,000 on those bets. So this is kind of an example of what we do. I'm looking for bigger moves in the markets. I'll keep, drilling into this and getting into this. A few weeks ago, I said buy the dollar yen at 117. And last week, the dollar yen went to 150. This went up over 3,000 pips over the course of the last couple of months. This was an email suggesting get long the euro yen, and that's what those positions yielded. So this is an example of what I do. It's all based on what we call technical analysis, all based on, what I perceive are opportunities in the market based on price patterns. So what I'm going to do now is, I think, given where we are with the elections tomorrow and, where the indexes are, what I'm going to do is I'm going to do a comparison. I'm going to do the Dow Jones, and then I'll look at the Qs. So you'll see that, this has been a very, very complicated stock market to trade. Sometimes I trade the indexes. Sometimes I trade individual stocks. I always say this is a market of stocks, not a stock market. There are some stocks like Tesla that are going down, and then there are some stocks like McDonald's that are making all-time new highs. And so you really have to understand what you're trading. Over the last 10 years, you basically could have just closed your eyes and bought anything, and it was kind of like a rising tide raises all ships, and everything went up together, and you could be brain dead and still make money. But I think those times are gone now. And this is very much a stock picker's market, and you really have to know what you're doing. So what I have is a comparison chart here of the Dow Jones Industrials on the top. This is a weekly chart. where each one of these price bars represents 1 week in time. And then on the bottom, I have the triple Qs. The triple Qs are an ETF that basically represents the NASDAQ. So that you can see that we've had a pretty significant rally already from the bottom. We've heard what a bad market this is. Meantime, the Dow Jones has gone from 28,000 to 33,000 in the last 4 or 5 weeks. It's gone straight up. But you can see by comparison that the NASDAQ is sitting on the very lows of the year. And so what you've had is a liftoff or a reset, and investors are going for companies that have real earnings and real cash flows, like a boring stock like McDonald's or Honeywell or Eli Lilly, versus concept companies that are yet to make money or aren't making money, or companies like Meta who don't even know what their identity is anymore. And so we've had a real disparity in the market. So it's not a one size fits all kind of a situation. You really have to understand which sector you're trading, which index you're trading, what stock you're trading, because they all have different characteristics and different energy. But to me, it all starts with a pattern. I try and find, markets that, are either trending or indicate a pattern in which you can understand where the energy is. So whenever I open up a chart, the first thing, I say to myself, what is this chart doing? So from here to here, this thing was just going straight up. All you had to do is keep buying the dips. And for a couple of years, this was the NASDAQ on the bottom. You just, this was what we call a trending market. And all you want to do is get in sync with the trend. But, as all good things in life, trends do end. And when they end with the pattern. And, I've been saying, I'm trying to find. So a couple months ago, or back in November, December, January, I was starting to warn. This was January 2022. So first part of this year, when the stock market was still making new highs, I was alerting our members that I'm starting to see a change. I said, since last February, I've seen a masking behavior of the major US stock indexes, where mostly based on the performance of a half a dozen companies, the stock indexes, keep going to new highs on the back of Apple and Microsoft and Google. Meantime, under the hood, there was just carnage in what I call second tier stocks like Zoom and Peloton and Beyond Meat, which I've been shorting for the last 18 months. And so I said, recently, there are cracks and fissures appearing in the most stalwart mega cap stocks, such as Netflix and Amazon and Apple. And so I was alerting our members at that time to a turn in the markets, even when the NASDAQ was trading at the very high, as you can see up there, because I was looking at this double top price pattern that I'll just share with you in just a moment. So to me, all the way back in January, I was alerting our members that this thing is going to turn, and it's going to turn hard. And then I was looking at this IGV ETF, and should blow this up. If you can see this thing, there was an arrow right here, and then there was a green line with a target. And so I predicted that the IGV, when it was trading at 380, would go to 260. And that's exactly where it went. And I'll show you that in a minute, but that was all the way back in January. So I was predicting what was going to happen. And again, I don't have a crystal ball. I'm going to show you how these charts, if you understand how to look at price, tell you what is going on. So right back in January, this was the double top that I was alerting our members to. So the market made a new high, it backed off, it retested, and then it put on what we call this M top. This is a reversal price pattern. So when we see these, after major rallies, this alerts us that there's going to be a change in direction. So again, I wasn't studying balance sheets and what have you. And by that time, you wouldn't even be able to see it. Because, at this time, this is what I'm saying, the markets are ahead of the news. Before, it was really becoming apparent why the markets were turning, the prices were already trying to tell us that, this was coming to an end. And that's why I say price is the truth. Price is ahead of the news. Price is the only thing you need to understand. So now, once I understood that the top was putting in, then the logical path was lower. Once you've made a top, a market can only do what? It can only go lower. And so that's exactly what transpired after that top kicked in. And now the real question is, where do we go from here? So I'm kind of seeing now that we're at this kind of major level. If you connect these lows all the way back here, you can see how we've come exactly back to, a level where there is a lot of support. And now we have a catalytic event coming in the form of the elections tomorrow. So I don't look at the news, I anticipate, and then I look at how does price receive the news? How does price assimilate the news? How does price digest the news? What does price do, with the news? I don't try and figure out, okay, this is going to be the implications. To me, I let the markets do all of the work. And so again, this is a very early bet. I said right at the top that I took a gamble. I made it up in my mind that, I was going to do this. And I think you should always have a plan. So early today, as we started going lower, I just started buying those call options. And I'm anticipating that we're going to make a little bottom here and we could see a nice little rally out of this. And so again, this is a very early call. It's a bet. It's not really substantiated. I'm seeing what could be a bottom, but really we need price to kind of share with us. But if you get, the early bird catches the worm, and if you catch this thing early, you might be rewarded. And I just have a visceral sense that we're going to get a changing of the guard tomorrow. And the previous guard, without getting into a food fight, put forward the most economically incompetent policies. And if we can get some kind of reversal from that, I think the market will like it, at least in the short term. So you can see that we're kind of stuck in this channel, and we're like in the middle here. So now it's really an open question, do we bump up against the highs here or go toward the lows? And so again, I will preface this by saying that I took a bet. I'm just kind of have an instinct that markets have bottomed here, and that, we'll take a shot up to this 300 level on the triple Qs over the next couple of weeks. So we'll see how that transpires. Now on the top chart, we have the Dow Jones, which is going in a much different direction. This thing's already going north where, like I said, the triple Qs are right on the floor. So it's a whole different market, trading the industrial stocks like Boeing or, Dow Chemical or what have you, versus, Meta or Netflix or some of the Amazon, some of the high-tech mega cap stocks. And I think this is also the difficulty that, I was talking about with my members this morning in our early morning session. We've all been hostage over the last 10 or 15 years to the names like Apple and Amazon and Facebook, these FANG stocks, which were dominating the markets, dominating the indexes, going to all-time market capitalizations. And now you're going to start seeing a changing of the guard. They're not going to be the dominant stocks when and if this market turns. So we're going to have to start thinking about different names to look at going forward. So again, now you can see that we're bumping up against this resistance level in the Dow. And, we could get substantially knocked back here, or we could, break out. So this is, a very complex kind of area where even if you break out, you hit other areas of resistance. So again, you have two markets at two different levels of their trajectory. And, I just look at the price levels for different risk reward outcomes. And so this is what we, have going on right now. I did mention Tesla. And so even though I have a feeling that these indexes are rallying, I am short Tesla. So it's very kind of hard to keep two thoughts in your mind, but this is why you have to be very objective when you're trading the markets. You have to just look at the price and you remove emotions. And when I look at the price of Tesla, it just tells me that this stock is in serious trouble. And over time, and I use that word or that phrase, over time. So again, what I look for in a chart is, are we in a pattern? In a trend? What is the trend? What is the direction? And certainly, from 14 to 400 over the course of the last several years, the trend was certainly higher. But then, when trends end, before they end, they always end with a pattern. And in this case, just like with the NASDAQ, we ended with a double top price pattern where prices went to the peak, they backed off, they retested, and then when they crossed the neckline, it basically confirms that this pattern is real. Now, the market, takes its sweet time, even though we see these patterns, even though we kind of understand where the market wants to go. The market, does a good job of taking out the weak hands before it goes. But what I like to say is that once you understand what is the governing pattern, and this to me is the governing pattern, this pattern here will govern and dictate the movements of Tesla for weeks, months, and possibly years following, culminating with this price pattern. So over time, this is what I expect to see in Tesla, based just on this picture. So now I'm making a mess of things. But that is what I call a governing pattern. This is what we look for. We look for a certain heads up in the market that tells us which way we want to be facing. Now, that's not to say that, there's not significant what I call counter trend rallies when the market goes counter to its main direction. And I do trade those, but I'm very mindful that I'm not going to overstay my welcome because this is the real trend. And so this is what I look for in price. I look for price to give me a heads up on which way to face and how to set my risk and reward accordingly. So once we saw that double top, you had another double top right here in this time frame, and then you had another one right here. So you had really three really bad, ominous looking price patterns telling us that this is over. Now, for many years, I've been calling this a parabolic implosion, meaning that when a stock goes straight up from 14 to 400, as meteoric as this rise is, typically it comes down in the same way. Bitcoin comes to mind, where Bitcoin went from 4,000 to 65,000, and now it's at 20,000. So, the old adage, what goes up comes down, and probably comes down just as hard. So now we're at this critical inflection point where we have all of these bear price patterns in Tesla, and we're just about to go over a proverbial cliff. but it's not without peril. So in addition to these double tops, now in a, if you kind of take even a wider view, and again, this is a weekly chart where each one of these price bars is 1 week in time. And this is very different than most people using a 15-minute or 1 hour. I like to see a big picture. I like to understand, the cards that I'm holding. Most people, if you're looking at a 15-minute chart, you can't see enough history. And if you don't understand history, then you're just going to be caught up in a momentum that you don't understand. So on a 15-minute chart, this market looks like it's going straight up, and then you don't understand why it goes that way, because this in that time frame basically told you that's exactly what's going to happen. So now, in addition to this double top, you also have what we call a head and shoulders. It looks just like a man or woman's left shoulder, peak is the head, and then you have the right shoulder. And when you stand back, it looks like a man or woman's head and shoulders. And that's basically what we're seeing now in Tesla. Left shoulder, peak is the head, right shoulder. And here is the neckline at about 180. So we call the neckline, which is simply a line drawn through the pattern. This is really what confirms the pattern. So sometimes we see these patterns, they stop short and they go the other way. But if we go through the neckline, then this confirms that this bear pattern is on. Usually you break out, you do a retest, and then you go down for sure. And then this whole thing just tells us that that's what's in motion. And I don't think this will be too far from the eventual truth in Tesla. I think we're, as crazy as it sounds, this is probably going to be a $40 or $50 stock. And, I predicted that in Zoom. When Zoom was 600, I said it was going to 80. When Beyond Meat was 210, I said it was going to 40. It's now 15. When QuantumScape was 170, I said it's going to 20. It's now about 10. So, I don't have a magic ball. To me, I just look at the charts, and the charts, by virtue of the patterns, have implications. These patterns have implications. These patterns tell me that it's over, that there is significant what we call distribution. These are where Elon Musk and his friends and all the institutions are getting out, and they're handing over their stuff to you and happy to let you have the paper. So this whole thing has been a distribution. Basically, everybody's been getting out. So now you're left holding the bag if you're long here. Now, it's not to say that you can't have substantial rallies in bear markets. In fact, bear market rallies are some of the most substantial rallies you'll ever see. And so you could get to an area and then, you could have a rip your face off rally before it goes back down. But you have to understand what the game is. And if you get one of these rallies, to me, they're just great opportunities. So this game is all about, understanding the cards you're holding and then, playing it accordingly. Mark says, is it the same for Moderna? Yeah, so we can get into, long discussions about all of these. I think for the purposes, of this is what I want to do is just introduce you to a framework, a way of looking at prices. And then you can overlay that on top of anything that you want to trade. Gold, corn, natural gas, the euro versus the yen. You can just overlay, that kind of analysis. So now what's going to also be important to the stock market short-term and long-term is the trackings of the US dollar. And that's kind of the other reason why I kind of think that we may have a stock market rally, because it does look like the dollar, at least for the moment, has peaked. So you can see that we have the emergence of a double top or even a triple top price pattern. Now that, it hasn't been confirmed. This could be just an interim thing before we kind of go back and have new highs. But, this is where it all starts. And then I look at both the pattern and then as well as what I call the price action within the pattern. So if you'll notice right here, when you made a new high, an all-time new high, by the end of the day, the sellers were in control. It closed right on the lows. And then it banged up right against that old high. And by the end of the day, buyers couldn't hold on and the sellers were in control. So it's the combination of this double top where you see two peaks at the same area, as well as this very weak price action where the buyers just couldn't hold on to the highs and then the sellers were in control. So, once I kind of see that, we have this, and the same thing here. You try and make a new high, by the end of the day, the sellers are in control. So sometimes price actually points to where it wants to go. This guy was telling you that, we're going lower here. And so the dollar is also going to be a very key component as to whether the stocks can get a major, a minor lift here. And I think we've just had such a one-way freight train in bonds and stocks and gold that it's very possible that we get a relief rally this week. And we see the dollar come down, we see stocks go up, we see gold go up. But again, that's pretty hypothetical. We're going to see some very violent price action, after the close tomorrow, and then certainly into Wednesday, Thursday, and beyond. So again, it doesn't really matter what the backdrop is. What I try and do is assess risk and reward relationships. How much risk do I have to take? And then what kind of outcome, do I expect to make from that? And so sometimes when a market's already gone, when a market's already made a substantial move, your risk reward becomes, much more undetermined because there's not that much left on the table. But what I try and do is find a very small pocket where I can hang out for a much bigger reward. And, maybe an example of that is, let's say, Bank of America. So this is Bank of America, ticker symbol is BAC. It's basically something that's been going straight down for a while. Again, trends end, and when they end, they put on a pattern. And you have this double bottom, you have this kind of what we call an inverted head and shoulders, which just is an upside down head and shoulders. And now you're sitting at this huge, what I call neckline. And basically we closed above it today. So now just visually, and I'm very aesthetic, I just kind of look at things and say, is it easier to pick prices going this way, or is it easier to roam into this open space here? And so again, what I like about this is that this has established some chart patterns that look like this thing is turning and ready to turn higher. But now I can basically establish a risk reward relationship by saying, if I get in here and put my stop loss there, I'm literally taking like $1.50 risk to try and make 10. So this is what I'm talking about in terms of finding areas where it doesn't matter what the Fed's saying. It doesn't matter if we're going into recession. It doesn't matter who's going to win the Senate tomorrow. It just matters that I can get in here, take $1.50 risk, and maybe make $4 or $6 or $8 or $10 out of this stock. And that's what trading really is. All this other stuff is just cocktail party conversation to make you sound intelligent. It's all about risk and reward. And so most people, certainly in the FX market, are trading for, 5 pips or 7 pips or 15 pips. But it's very limited outcome, meaning that this is, 90%, I think it's actually a much higher statistic of people are losing in the FX market, certainly, because I think they're trading too short term. They're looking at 15-minute charts, and they're trading multiple times a day to carve out 5 or 7 or 15. It's like a squirrel running out of his tree, hunting for nuts and then going back in the tree. You're trying to grab your pips before the broker grabs you. And that's just a losing game, because, if you're trying to make 15 pips, you have to risk 15 pips. Then you have to overcome the 2 or 3 point spread. And then you're trying to do this 5 times a day. And then you're trying to do this consistently, over time. So this is just a risk reward of 1 to 1. It's actually less if you've got the spread calculated, meaning that whatever your outcome is, that's what your risk is. It's kind of like going and playing, roulette. You put on red or black. You either win or lose. That's why I hate it, because you can't limit your risk. You can't make more, if you win. And it's the same kind of thing here. If your outcome is too small, you'll never be able to make money. To me, I try and look at moves and try and take a piece out of the middle of a big move. So if a stock is going to move, $8 or $10 like this, I just want to take $4 or $5 out of the middle. And, risk, $1 to do that, or $2. So in that case, if I'm risking $2 and my objective is to make 6, this is a 3 to 1 risk reward ratio rather than a 1 to 1. It's a big difference. If you, on every one of your trades, say, whatever I'm risking, my outcome is 3 times bigger. In this scenario where you have a 1 to 1, you have to win 90% of your trades or more. If you have a 3 to 1 risk reward, you can actually lose 72% of your trades. So this idea of having to be perfect on every trade, win on every trade, is just a myth. I can lose 4 out of 5 trades and make it be just hugely profitable. If that one trade, I can hit it out of the park. And that's what I try and do. I keep on trying for that one trade where I can make a bigger outcome. And that is the key to longevity. That is the key to being profitable over time. If you're trying and trade 5, 10 times a day for very small outcomes, all that's going to happen is that the broker is going to end up with your money in their pocket. So what I'm trying to do is risk $2 here to make 5, make 7, make 9, make $10 on a trade like this, and take a piece out of the middle. Does this make sense to you guys? When you learn the patterns, you can make 50 or 60 pips on lower time frames. Yeah, Neil, I just think when you kind of go back to lower time frames, it just invites over trading. You don't really see the big picture, and then you just spiral backwards, and it's very easy to fall back into habits. And everything is about habits. Everything is about learning a new way of doing something, and it's not easy. If you go to the gym and you want to teach your body, how to adapt to new things, you hurt for several days, it sucks. But over time, it becomes a lifestyle, right? So habits take a while, and then it becomes a lifestyle. And if you keep on kind of going back, well, I'm looking at this, and then I'm going to go to a 15-minute chart, or I see a trade here on the 4-hour. And I still have a trouble fighting that, toggling between these, time frames and what have you. But to me, really what it comes down to is that, I have a certain objective when I'm trading. I don't want to sit in front of my screen and constantly stress over the next, micro move. If I don't snatch it quick enough, it's going to go and what have you. So I'm trying to look at trades that are going to project for bigger moves, that I can take bigger moves out of the market. I started shorting Tesla at 220 on Friday, and right now it's at 197. That's $23. So that's what I'm looking for on my trades. Crystal, Brian says yes. Sunil says yes. Edward, yes. Marlene, you're welcome. Yes, yes. Antonio. So that is, again, I just look at patterns, and patterns equal trajectory. Now, they don't go in a straight line, and sometimes when it comes off, I use that to, to buy that weakness. If I believe that this is the governing pattern, I then use weakness to buy more. Like Tesla, I use strength to sell into it. So on Friday, Tesla actually rallied like $6. And I said, okay, I'm going to take that gift. I'm going to sell into that strength. So, on stuff that I want to buy, I buy into weakness, and stuff that I want to sell, I sell into strength. And, just like today, I bought these calls into weakness. When the market started to drop, I started, taking bets that the market was eventually going to rally. But it all begins with kind of understanding where you are. And you can see that there's a little area here where there's also another bottom. And so you kind of have two bottoms. So there's just a lot of support here, suggesting that this pattern could be a huge base for a liftoff. But again, it's the exchange. Even if I'm wrong, it doesn't matter, because I'm just risking $2 in here. And then where this goes, how it goes, who knows? But, if I can make $4, $6, and what I tend to do is that, goes up a little, I make double my money, I take off 25, 30% of my bet. Goes up a little bit more, take another 20% off, then put a trailing stop on the rest and let it just go where it wants to go. So this has been a very violent market. It's been a very difficult market to be long 2 days in a row or short 2 days in a row. So you've kind of had to actively kind of trade it. But there are times where the market starts staking out patterns. And I believe this is one. This is just a huge base. And the bigger the base, the more into space. So I do think that this is setting up for, a monster rally where you should be able to make 10, 20%, on your money pretty quickly. And if you're operating on leverage, you could make quite a bit more. So that is stocks. I'll just take a look at gold before, just to kind of give you a flavor that you can use this kind of analysis. So we looked at the dollar, we looked at stocks, and now we're looking at gold. And gold's kind of a difficult one, because long term I see some bearish price patterns, and short term I see a support. So I will trade, shorter term rallies, kind of knowing that, at some point, I just want to get out. So, here is this big bad double top. Now, sometimes, prices start not respecting those patterns, and we call them busted patterns. And then this thing can go and make an all-time new high. But what I'm seeing here is that this thing has stopped going down. So, if something is stopped, it's like pushing on a string. It's like pushing that beach ball in the water. You push, you push, you push, you take your hands off. What happens is just, the energy just uncorks the other way. And so this is where you can see that we've stopped in the same area, right above the 1600 price level. But to me, again, what I focus on is the price action. We made a new low and we close on the high. We made a new low, close on the high. We made a new low, we close on the high. So now that is a very difficult area to just bomb through here, and go that way. So now I don't know if it's going to go higher, but this is not something you want to fight. And if you want to take a shot, I think that you've got a pretty good shot of, getting perhaps a rally out of here. And again, Wednesday is going to be just a huge day, once we kind of understand the results. And actually, we may not even understand all the results. You might get runoffs and there may be complications, and who the hell knows. So now we're bumping up against this resistance. And if we take it out, you could get a short, what we call a short covering rally, where, everybody who's, short wants to get out, so they have to buy. Everybody wants to buy, buy so that you get this monster barn burner the other way. And you do not want to be on the other side of that if you're short. So you can see there's just a lot of buyers in this area. You notice that every time you make a new low, you close on the high, in this geography. So in the zip code, it's just very hard to get through. And so the market is kind of pointing that it wants to go north here. So, and again, the nice thing about this is that you can kind of get in here and understand what your risk is. So this trading is all about risk and reward, and it's all about dialing the smallest amount of risk for the biggest amount of reward. And you don't always get that. Sometimes the markets are in different phases where they've already trended. And then, you need to just wait until things consolidate, where you can identify a very small pocket where you can hop on board, test out that trade, see how it feels, and then maybe, ride a huge wave. And you don't need too many of these to, just make a huge impact on your trading account. So Eduardo says, if it builds a base that big, does it mean we're still in a downtrend? So this is where trading gets a little bit challenging, right? Because what I do, and I kind of gave a whole dissertation. So we have a program in the morning. It's called the Boiler Room. It starts 45 minutes before the US stock market opens. And so I can see in the pre-market session. So just like now, we have a post-market session. The markets are actively trading right now. Tesla's trading and the markets are trading. You don't really see the lights. It's not too active right now. It's actually not active. So you can see the lights are going off. There is trades going on. So in the morning, before the market opens, there are also trades. And I will look to take advantage of trades before the market even opens. If I see a market's coming in lower and I want to buy something, I'm going to use that. Conversely, if I want to sell something that's coming in higher, I'll sell into that. But what I was saying this morning was that the markets are fluid and dynamic. What you see in a textbook, so this is a very textbook double top and a very textbook head and shoulders. And this says that this is a bear price pattern. It says that over time, prices should go lower. So this is where, I get a little bit trapped, because on one hand, the big patterns tell me that this thing's going lower. On the other hand, I don't want to be facing this. So if you're short, if the market's going down and then you see a bar the other way where it makes a new low and closes on the high. Now, you can't trade all reversals equally. That doesn't mean you should go long and buy every time you see a reversal. But to me, this is just a headwind. If I'm short and then I see one of these guys, I go, you know what? I'm just going to get out and reevaluate. Same thing if you're going long and you're this, and then you see one of these. And then, you know, I was long the stock Bumble last week. I made a lot of money a few weeks ago. Then I got long again. I was making a ton of money. So this is, you know, where one pattern gives way to another. So you can see Bumble had this gigantic double bottom. And when I saw this, I was using this weakness to start buying calls. I was buying the $35 calls down here, you know, for like nothing, 30 cents or what have you. And then I made like 5 times my money when this thing rallied. You know, 30 cents went to $1.50. So I used this pattern in this instance to trade higher. But then you can see the market went up, but then it kind of gave way to another pattern where you see this double top and this head and shoulder, just like we see in gold. So this is what gold looks like right now. So it's entirely possible that gold can go down and still do this week. But we could get a false rally because this is the dictating pattern. And then we came down and we put what I thought might be a bottom down here. So you had a bottom here, you had a bottom here, and the question was it sustainable? So I got in here, I bought some call options, I was making a lot of money. This day it opened higher, went higher, but you can see by the end of the day, it collapsed. By the end of the day, I was long, it made a new high and closed on the low. So that's it, man. I don't ask any questions. When I see that kind of information, and the market does give you information every day. If you're long and you see this, I'm not going to argue. You know, and then the next, so I got out down here. The next day it opens higher. I'm pissed that, you know, I could have maybe gotten out at a high price and then the thing just collapsed. But the point is that price gives you information all the time. So I always say price puts me in and price takes me out. So, but this is a good example of how one pattern gives way to the other. And that's the nature of markets. You kind of have to be fluid and dynamic. And it's hard to kind of explain all of the nuances on a presentation like this. I've been doing this for so long that, you know, it's just hard to, it's almost a visceral thing. It's almost a instinctive thing. You know, when the market's rallying like this, it looks all good, but then you have to say that's the operating pattern. And it's really perhaps the same thing in gold. We'll have to see. Where gold looks like for all the world like it wants to rally, but I suspect it will be what I call a dead cat bounce, where it will not sustain. So just like Bumble, this is exactly the pattern that was dictating that. And so we could get a monster rally over the course of the next what have you. And it would be a dead cat rally, a dead cat bounce. And I would expect this thing not to sustain. But that's not to say that you can't get, you know, a huge move from 1600 to 1750 and still be in a downtrend. So the markets have a cadence. And, you know, but I will take a position here on the view that I can see that there's some short-term support. So now I'll take a shot here. And sometimes the market is all about probing. You take small shots, see how they feel. They don't work out, you just move on. But I would take a shot on a kind of a relief rally here, a counter trend, but I'm not looking to overstay my welcome. I make $50 on this trade. I say good night, thank you very much, and I'm gone. and then I'll watch for signs of a turn when it's ready to go back down. Mark says, have some trends reversed and went on to be an all-time high even after having a bearish governing pattern? I'm trying to think. If it had a bearish pattern. So this morning I gave a great example of that, and this may kind of give you more insight into that question mark, and then I'll leave it there. So this is a great example of how the markets do their job. They give you a heads up, but then, you know, they can go the other way. So this is Caterpillar. I'm just going to wipe out this recent history. So when I was looking at this chart, I saw a perfect pattern, double top. You know, it just checked a lot of boxes. I saw perfect price action. I call this a key reversal. Made a new high, close on the low. Made a new high, close on the low. Now this was also a higher time frame. So this was a weekly chart. And the bigger the time frame, the more impactful the outcome. So this was the evidence after a week. After a week, this closed right on the lows. Both times it hit the highs and closed bang on the low. So now I had a double confirmation of the pattern and the price action. And, you know, I predicted that we were going to go lower in a hurry. And that's exactly what happened. This pattern did its job. It said at 215 bucks, this thing's going lower, and you went to 160. So whatever you were looking at, it was correct. And then you kind of had this downsloping head and shoulders, and you had this neckline. Now, typically when you see, you know, a head and shoulders like this with a downsloping neckline where it's not horizontal, you know, it's not like horizontal, it's downsloping, it actually indicates a much swifter and more violent move to the downside. And that's basically what I was anticipating and expecting. And basically, if you saw this in a textbook, you know, you'd see this and go, okay, fine, I understand double tops and head and shoulders, and this is how it works. But that's a textbook, and this is real world. And so it's taken me years and years to evolve what I call dynamic charting, where I draw my boundaries and structures around the market, but then I defer to the market. The market is always right. The market is always going to tell you where it wants to go. And you can see, so this is the confirmation. If it breaks through here, now it's confirming that this bear formation has been made and that we're going to go lower. But you can see it stopped right there. And then what happens is, if a market doesn't do one thing, it's going to do that other thing. And it doesn't sound extremely sophisticated, but that's my operating thing, is that I have a thesis. You know, I look at this thing and I say, this is very bearish. And then I have kind of a visualization. And this is what I do every day. I kind of draw this and say, this is what it should do. But if it starts doing that other thing, then all kinds of, I've been trapped too many times. I've lost too much money. And so now I start understanding where those traps are. And if a market doesn't go one way and then starts ignoring the implications of these patterns, then it becomes what's called a busted pattern. So it just busts the implications of all of that. And that's exactly what Caterpillar did. It basically stopped right on a dime to the penny and started ignoring and busting the implications of that down move. and actually started forming. So one pattern, just like Bumble, gave way to another. So we started with a double top, it went down, retested, and now it's formed a double bottom. And now this is the operating and governing pattern. And so this is the nature of the markets. They are dynamic and fluid. And if you keep kind of a fixed outlook, the Fed's going to do this, or the economy's going into a recession, or you hold on to some thesis, behind that thesis is an ego. And behind that ego is a need to defend that ego. And this is where you get into all kinds of trouble, because you start doubling down here and then it goes right up your ass. So, I started out by saying I'll help you identify the opportunities, but also the traps. And this is where it traps you. And it's very subtle. And it took me years to figure this out. So I'll look at Apple tomorrow, Devendra. I'm going to end it there. And really what I want to share with you, this is just a way of looking at the markets. I didn't discuss Fed policy. I didn't, discuss what I think of the GDP numbers next month. I didn't discuss, my forecast for inflation or consumer sentiment. I'm just looking objectively at price in a vacuum and making decisions. So this is what I call an inside bar. The week hasn't finished, but let's assume this is just the week, that it ends right here. This is what I call an inside bar coil. What this says to me is that this is just building energy. You can see that, the range from high to low sits within the range of the prior week. And so now I've deduced that we made this bottom, and the path of least resistance now is higher. So now I want to get in sync with that move. I want to go long. So to me, what I would do in the following week is simply put a buy stop to confirm what I'm looking at, slightly above the high. And you could put a sell stop maybe a little bit outside the low or under the low or what have you. Your stop loss, So now you have your risk reward. This is your risk, and that's your reward. And so once I kind of understand what side I need to be on, then I look for price action in the form of what I call key reversals or inside the day or inside week bars, to then start getting, you want to join that trend, and you also want, understand where the risk is. So basically I'll use this little small bar to understand where to get in and where to put my stop loss. So I have two things. I know where I'm joining this thing and where my risk is. And to me, that's the holy grail of trading. If you understand how to get in sync with the trade and where your risk is, where this goes, how far it goes, when it goes, those are unknown. Those are things we can't control. But I can control my entry, I can control my risk, and I can try and get in sync with the major moves. And if you do that enough times, you're going to make a hell of a lot of money. Thank you, Eduardo. Great information today, Eduardo. So thank you. Neelish says, good night. Thank you for this free webinar. You're welcome, Tio. And we will see you tomorrow. Thanks, Dwight. And I'll see you guys tomorrow at 4:30 Eastern time.
All right, Mark, see you tomorrow.
Thanks. Thanks, Loris. I appreciate it.